This video, How to Define Risk-Reward Opportunities, is the second part of a two-part introduction to Decimal. This video is dedicated to Paul Tudor Jones, who I consider the greatest alpha generator and asset manager of our time. The genesis of all profitable trading is creating favorable risk-reward opportunities. Ultimately, everything comes down to risk-reward analysis. In part one of this two-part intro to Decimal, you learned how to interpret a Decimal weekly chart and how to recognize an alpha 1 signal. To review, an alpha 1 buy signal context occurs when potential buyers appear below the next week in the form of a white star black dot, and that occurs coincident with the green dot below. In other words, when clock rotation has been reset, combined with the semantic pattern model. Therefore, to the left of X in the white circle, those two conditions are present. In essence, Decimal is designed for you to literally plug in whatever strategy you're currently deploying, and it will transform that strategy into one with positive expectation by making it more selective at critical points in time and price. Another way of describing this interaction is that you can take any Decimal to alpha 1 signal and then filter that signal according to any long-standing framework which you have confidence in and that has validity, and it will generate a trading protocol that has inherent positive expectation. In the example that follows, we'll plug in the Trend Dynamics Strategic Framework, which is essentially a swing pattern-based framework built around a semantic rule set called the Laws of Trend Dynamics, integrated with objective rules for swing analysis. However, one can just as effectively use other valid existing frameworks, such as a higher time frame moving average strategy, which is based on robust tendencies for reversion and excursion from the mean. Decimal can also be used effectively with structural chart patterns, such as those articulated in the Edwards and McGee classic work Technical Analysis of Stock Trends. By the way, classic chart patterns tend to be more robust in higher time frames than in lower time frames. In sum, Decimal is transformative when used with just about any strategic framework, so long as that strategy is robust over a multi-decade time period and not some transient observation over a limited data set. My personal recommendation would be to use a combination of an unconventional strategy like Trend Dynamics, which is described in general terms in the rest of this video, combined with a more conventional strategy like long-term moving averages. Earlier I quoted Paul Tudor Jones, who's widely known as a global macro manager. However, it's often overlooked that one of the key reasons he has been so wildly successful at creating risk-reward opportunities is because his skill set spans the full spectrum from the tape reading skills at a micro level and floor trader to the fundamental and macro level. This is very important because when one has a wide differential in understanding from the micro to macro level, that provides a greater opportunity to create handoffs and asymmetries from low time frames to higher time frames, which is fundamental to creating risk-reward opportunities. So let's now take a look at how you can learn and execute this type of process with Decimal. The strategic framework we've chosen to plug into Decimal is Trend Dynamics, more specifically the seventh law of Trend Dynamics, which is a semantic pattern rule itself, which simply states that dramatic price movements tend to unfold from price structures that minimize profitable participation. So if a market is going to offer an opportunity for a profitable rally, then one way a market will minimize profitable upside participation is to first manifest a correction that flushes out long positions at levels where stops logically aggregate. There are two obvious swing bottoms, which would be structural levels where trailing long positions will be flushed out. First, notice the green bar at C emerging out of a multi-week or floating month congestion. That green bar defines the swing bottom at A as an isolated swing bottom, which is a special and important price event. Then the correction from the high down to B develops into another obvious swing bottom. So the correction down from T to D and X fulfills the seventh law semantic because that price action minimizes the ability of longs to continue to hold long positions by violating the swing bottoms at A and B, which ironically creates the very opportunity to trade the long side. So coming into the opening of the prior week at D, we're stocking a potential seventh law long buy in daily time frames because Decimal Strategic is signaling that a trend dynamics-based strategy will be most effective when supported by the alpha 1 signal. After the week opened at D, the daily price action developed to the downside, so there was no lower time frame entry. But the clock reset and the alpha 1 signal reiterated as of the close of that week. So coming into the new week at X, we're actively stalking along again in the lower daily time frame, as the trend dynamics 7th law filter is also primed because price has just minimized the potential for upside participation by violating the isolated low at A and B. So during the week noted at X, we have a right potential to trade the long side, and we're going to stock that long side in the lower daily time frames while also following a risk-reward discipline. Here's how it's done. To define risk-reward in a meaningful way, we need two essential pieces of information. First, a high probability minimum profit target, and the operative word here is high probability. One can't use some random price level that may or may not be probable. The second crucial piece of information is evidence in the form of tactical price action that a swing bottom and or weekly low is developing, so we can define a meaningful risk or robust stop level. Once we have those two pieces of information, we can draw in a grid that allows us to calculate at a glance risk-reward ratios relative to our entry and the initial profit target. We know that the swing that preceded the move down to wash out longs on a breach of the swing bottom at A was initiated by the red fire bar at B. That price event created an important isolated swing top. Again, isolated swing tops are created by the yin-yang model, which identifies fire or red bars and tree or green bars. The high of the fire bar price event at B, and not the swing top at T, defines the high probability price objective should price turn back up. Most technicians consider a retest of the high at T, new highs, or a fib retracement up as the probable price objective, which is often incorrect and leads to erroneous risk-reward calculations. A new high target is only correct if the trend is in a high momentum condition and about to immediately reassert itself. More often than not, assets tend to remain in trading ranges longer than most participants expect. The zone defined by the two yellow lines between the high of the red bar week at B and the 3 or 4 o'clock vector is called the alpha zone. These alpha zones are very robust, high probability initial targets in all time frames, and Decimal provides the visual tools for defining such targets. Of course, because the higher time frame trends are still up, we know it's possible the dollar ramps up to make new highs. However, if we want to trade with a high win ratio, we would initially target the more conservative alpha zone as an initial reward target to either close the trade or to take off part of the position in order to hold a core long with the trade location near that swing bottom, supported by the long-term moving averages below. In this case, which is an actual trade that we executed in-house, I selected a 98.08 target near the midpoint of the zone. In trend dynamics vernacular, we call this tactic an NTL, or non-trend liquidation tactic. This protocol allows one to still make money on the trade should the trend-based assumption of new highs not materialize, which is often the case. And importantly, by taking profits in the alpha zone, it frees up margin capital to fund new ideas, and should one hold a core long after taking a partial profit, it provides a profit and psychological buffer to withstand a retest of lows. So we have a high probability initial target defined in the alpha zone at B, and we also know that if a tactical entry is elected during the week at X, we can define risk just below the low of that week and thereby extract the second piece of information we need for risk-reward analysis. We now turn to the daily dollar chart for the period in question to stock the entry at a more granular level. The week referred to at X in the previous chart commences with the Monday price action for 5/18 of 2015, which is the bar labeled C. It's important to use a lower time frame for tactical entries than the time frame one uses to analyze the trade and the trend. Ideally, and this is also important to note, we want to see an entry tactic that tends to isolate a potential or developing low of the week. For example, if the Monday-Tuesday range of a given week is breached to the upside, the low of the Monday-Tuesday range for that week tends to hold, which defines a directional bias. The blue line at A represents that weekly swing bottom on the left we called an isolated swing bottom. We see the 7th law price action as the selling pressure down to B, through and below A, violating that important swing bottom, which minimizes long side participation should this market reverse back up. In trend dynamics terminology, we identify that as a 7th law price event, as described earlier, and quantify that selling pressure, then look for an offset or reversal of the selling pressure, which is a specific kind of simple trend dynamics tactical entry, which I won't go into detail here. And as mentioned, this is the spot where you can use just about any proprietary entry technique or effective tactic you've developed. So a tactical entry occurs at C and D, which indicates that the conditional probability that the low of the week may be developing is now becoming a reality. So risk is suddenly becoming quantifiable. So the second piece of information we need is now at hand. We now use a modified fib retracement tool to draw a visual risk-reward grid or calculator. I just took the default setting for a standard Fibonacci retracement tool and turned off all lines except the 50% line, which you see is yellow, at F, then changed the 0.618 line at E to magenta, and changed the value to 66%. So in essence, I kept the 100% red line at B and the 0% blue line at X, which were already default settings, and only display a 50 and 66% retracement line. I'll explain why in a minute. As soon as a tactical entry comes into view, in this case there's a trend dynamics based tactical entry at C and D, we can anchor the grid at B as a potential bottom and stretch the grid up to our known target at X. Visually, we can now see the risk-reward dynamics at a glance. I know that if a tactical entry is triggered near the magenta or 66% line, then I know I have roughly 1 unit of risk for every 2 units of reward to the target at X. So the tactical entry at C and D had 1 to 2, or perhaps close to a 1 to 3 risk reward. In trading literature, you sometimes see a rule of thumb suggesting risk reward should be 1 to 3. That rule of thumb is meaningless because it does not account for win ratios, the probability of a win. When following the protocols we suggest in these training videos for validating a decimal alpha 1 or alpha 2 signal, decimal-based trades have a 70% or higher win ratio, and that's not including any core positions that run. Therefore, a trade setup supported by higher time frame trends can generally be taken in the alpha entry zone defined by an entry inside of the 1 to 1 and 1 to 2 levels, the yellow and magenta lines. If this was a counter trend trade or marginal trade, or the higher time frame was not clear, then one might adjust the entry level to a minimum risk reward of 1 to 2 or higher. In this specific case, I went long the dollar at D with a stop some points at a new low and booked all but a core long on the run up to the alpha zone at X. This protocol, where we define a high probability target, monitor price action for a tactical entry that defines a swing bottom, and then draw in our risk reward grid, is a trade protocol that I recommend for developing high probability swing trades and exploiting asymmetries in time and price. And Decimal is designed to provide the key information necessary to do this type of risk reward analysis. I've been developing technical models for nearly 40 years and refining decimal algorithms for over a decade, and I assure you this process is robust in all markets and all time frames over the past 50 years and more, and that if you gain proficiency at following this protocol, you should experience win ratios of 70% or higher. Whether you use the decimal edge or not, I can't emphasize enough that this type of process detailed here, where your trade is anchored in risk-reward analysis, is indeed, as Paul Tudor Jones suggests, the genesis of all profitable trading. This concludes part 2 of your introduction to decimal, which is composed of 2 parts. Part 1, how to read weekly charts with decimal, and part 2, how to define risk-reward opportunities. To complete your decimal training, I highly suggest you explore at least 2 more videos in the resources decimal training section of our website. In the video titled Strategic Trading with Alpha 1, you will find several Forex, stock, and futures trades with more examples of our suggested protocol for trading the Alpha 1 algo. In the video titled Tactical Trading with Alpha 2, you will learn our suggested protocol for trading the Alpha 2 algo.